Welcome back to The Explainer. Today, we're jumping right into a company sitting at the dead center of one of the most fascinating mysteries in the financial markets right now. Just recently, Boeing stock dropped a staggering 7.54% in a single week. Now, if you just glanced at that chart, you'd probably think the sky was falling. But when we actually peel back the layers and look at the underlying numbers from their latest Q2 2026 results, they reveal this incredible paradox. There's just a massive disconnect between the company's ground floor reality and what the market is reacting to. So let's unpack exactly what's going on with one of the world's most critical aerospace companies.
Okay, let's dive into this, because this number is the absolute anchor of the entire Boeing story right now. $715 billion. That represents Boeing's current record-breaking backlog. We're talking about guaranteed future orders for over 6,200 commercial airplanes. I mean, think about that for a second. Most companies have to spend billions just trying to convince people to buy their products, right? Well, Boeing doesn't have that problem. Global airlines have already lined up, checkbooks in hand, desperately demanding airplanes to replace their aging fleets and expand capacity. The demand is absolutely locked in.
And honestly, that brings us to the core paradox of this explainer. How exactly does a company operating in a massive global duopoly alongside Airbus, with $715 billion in guaranteed future orders, still manage to lose money? It almost defies basic business logic. The demand is undeniably there, the backlog's enormous, but investors are basically standing around tapping their watches, waiting for one very specific thing: sustainable, profitable cash flow.
Section 1. The Great Boeing Paradox: Revenue versus Reality.
To solve this mystery, we really have to separate Boeing's massive demand from its actual ground-level reality. Having customers lined up doesn't matter if your factory floor is struggling, right? But looking at the Q2 data, things are actually moving in a great direction. Revenue is up 8.4% to $24.6 billion. Commercial deliveries jumped 14%. But the absolute biggest win here is the free cash flow. Boeing went from negative $200 million to a positive $600 million. That is an $800 million turnaround. For the bulls, this is a massive signal that the factory utilization is finally starting to click.
But here's the glaring negative that completely offsets the excitement of that revenue bump. In Q2 2026, Boeing still posted a GAAP earnings per share loss of 67 cents. Yes, the loss narrowed from the previous year, which is good, but it's still a loss. The company is still not profitable on an EPS basis, and this is a totally vital mindset shift for anyone analyzing this data. Boeing is not a normal growth stock right now. It is a turnaround stock, and turnaround stocks can deliver incredible upside, for sure, but they can also destroy capital if the turnaround fails to materialize.
So, the crucial point to understand is this stark contrast. On one side, we have the absolute certainty of enormous demand. It's a duopoly. The barrier to entry to build large commercial aircraft is virtually insurmountable for new competitors. But on the other side, we see Boeing's Achilles heel, the execution problem. Having the orders isn't the challenge. The entire game for Boeing right now is literally just building those airplanes profitably, efficiently, and, crucially, without any more quality disruptions.
Section 2. The execution pipeline.
So how does an airplane order actually work its way through the system to become profit for shareholders? Let's map out the execution pipeline. Step 1 is increasing deliveries, which we saw them do, hitting 171 aircraft in Q2. That's an awesome start because more deliveries, particularly of the crucial 737 MAX family, drive factory utilization and supplier economics. But it immediately bumps into Step 2, improving production quality. You just can't ramp up the assembly line recklessly. Then comes Step 3, reducing manufacturing costs, which finally leads to Step 4, sustaining profitability. You cannot skip a single step in this pipeline without the whole thing breaking down.
Which brings us to the absolute most critical hurdle for the entire turnaround thesis. It comes down to this: can Boeing increase production without creating new quality problems? If they speed up the line but trigger new regulatory scrutiny or quality disruptions, the pipeline freezes, revenue stalls, cash flow burns, and that massive backlog just sits there gathering dust. That single question dictates Boeing's future over the next 5 years.
To truly understand the scale of this turnaround, we have to look at the timeline. Back in 2020, things got so tough, the dividend was suspended entirely. It took until Q2 of 2026, literally 6 years later, just to reach positive free cash flow of $600 million again. But the finish line here is 2027. That's the crucial milestone when Boeing expects its commercial airplane division to finally turn profitable.
Interestingly, that target was actually delayed slightly due to higher costs related to their Spirit AeroSystems acquisition. So 2027 is absolutely the make-or-break year that investors are watching.
Section 3. The dividend warning.
I want to pivot urgently for a second and address the income investors watching. If you remember Boeing's historical reputation as this reliable blue-chip dividend payer, we need a serious reality check. The current quarterly dividend? $0. The annual dividend? $0. The dividend yield is 0%. Boeing suspended its dividend back in 2020, and they haven't resumed a regular common stock dividend since.
So let me be as clear and direct as possible here, quoting straight from the analysis. Boeing is not an income stock. Anyone buying into Boeing right now needs to know they are strictly playing a turnaround and future capital appreciation thesis. If you're searching for yield to fund your retirement or generate passive income, you're looking in the completely wrong place. Boeing needs every single dollar of cash it generates just to fix its factories and pay down its debts.
Section 4. Buy, hold, or watch. So with record demand but persistent execution risks, where does this actually leave us? Well, first, let's establish the absolute worst-case scenario. When does Boeing become a definitive sell? It's a pretty simple formula. Rising revenue plus rising deliveries plus falling cash flow. Right now, Boeing is not in this territory. But if this formula ever triggers, it means the company is failing to convert its demand into actual economics. If they're building and delivering more planes but bleeding cash to do it, the turnaround would be officially broken.
Fortunately, the current data shows genuine improvement, which leads us to these 3 verdicts. The highest rated approach right now is watch with a 9 out of 10 score. This is really best for conservative investors who want to wait for that 2027 commercial profitability milestone to actually materialize before risking their capital. If you're already in, hold scores an 8 out of 10, assuming you can stomach the volatility while the turnaround takes years, not quarters. And for the aggressive investors, it's a buy at a 7 out of 10, but it is highly speculative. Do not put everything in at once. This is a gradual accumulation play because the execution risk is still very high.
Which leaves us with this final defining question. Can Boeing actually pull this off? The foundation is definitely there. The customers are waiting. But remember, Boeing doesn't need more orders. It just needs to make money on the ones it already has. So as you follow this company, don't just get distracted by the stock price or those massive backlog numbers. Watch the margins. Watch the factory execution. Watch the free cash flow. If they can solve their execution problem, the future is incredibly bright. If they can't, well, that $715 billion backlog won't be enough to save them. Thank you so much for joining this explainer, and keep your eyes on the data.